Hello, and thank you for joining the PAA Quarterly Update for Direct Real Estate. My name is Charlie Bagler, and I'm Head of Acquisitions for the Direct Real Estate Programme here at Pictet. Despite a substantial volume of raised capital targeting the private real estate markets across the risk spectrum, direct investment into European real estate in Q1 only reached €51 billion, a 35% fall on Q1 2020. Behind this headline, we can see a number of structural and short-term changes which have either been accelerated by or caused by the pandemic. Additionally, there's been an increased level of uncertainty in some sectors and markets, which has led to a flight to quality and a bifurcation in investor appetites. Demand for logistics and industrial assets continues to grow, fueled by an increase in e-commerce activity, which has been accelerated by the pandemic. Cap rates for prime and secondary logistics assets continue to fall, with upward pressure on rents caused by a fundamental supply and demand imbalance. On the other side of this structural trend, physical retail assets, particularly shopping centres and department stores, are facing an increased incidence of obsolescence. Notable tenants falling into administration in the UK include the Arcadia Group and department store operator Debenhams. We anticipate further challenges in the sector in 2021. If we now look at short-term changes, we are starting to see the first signs of distress in the hotel sector. The current third wave of the pandemic across Europe has cast doubt over the speed at which international travel will return. We see this as an exciting opportunity for the Elevation Fund, provided we can find the right entry basis in our preferred markets, with the key assumption that the forecast rebound in business and leisure travel may not take place until Q3 or possibly Q4 2021. The office sector is perhaps where the greatest degree of uncertainty lies. The speed and frequency with which occupiers are returning to the office varies greatly from country to country, city to city, and even business sector to sector. Despite this uncertainty, there is pre-leasing activity for new, high-quality prime space in central locations in London, Paris and Berlin, albeit we are seeing a flight to quality across the risk spectrum, and this demand is strongest in the core space, where appetite is driven by investor demand for long income streams secured against strong tenant credits. In the residential sector, somewhat counterintuitively, price growth has been widespread across Europe. There is a widening of the affordability gap, driving an increase in demand for residential property. This is manifesting itself with the further establishment of subsectors such as co-living, micro-living, affordable housing, and multi- and single housing build-to-rent. This overriding macro theme of decreased affordability and increased urbanisation, coupled with outdated housing stock across Europe, is driving our decision to spend more time reviewing opportunities in the residential space. Finally, I'd like to reference the structural change that is perhaps the single most significant topic that will shape our investment decisions, as well as inform occupier demand and even affect the pricing and availability of third-party debt going forwards. This is ESG, environmental social governance. By making buildings more sustainable, it is clear that we as investors are able to help the environment and boost returns from our investments. Occupiers, developers, investors and lenders are now all focused on this need, and it is having a clear impact on building design, performance and liquidity, which will ultimately impact pricing. Thank you for listening.